Financial Institutions Management, Chapter 13-14. Off-balance sheet risk, contingent assets, contingent liabilities, derivative securities, held off the balance sheet, forward contracts, future contracts, option contracts, and swap contracts. OBS activities and solvency. Off-balance sheet assets, off-balance sheet liabilities, valuation of OBS items, delta of an option, national value of an OBS item, delta equivalent or constant access value equals delta times face value of the option. Incentives to increase OBS activities, loses on LDC loans and reduce margins, produce profit instances, increase in fee income, avoidance of regularity costs or taxes, reserve requirements, deposit insurance premiums, capital adequacy requirements. Schedule LOBS activities, loan commitments and interest rate risk. If fixed rate and commitment bank is exposed to interest rate risk. If floating rate commitment, there is still exposure to bias risk. Takedown risk, uncertainty of timing of takedowns, exposes bank to risk. Back-end fees are intended to reduce this risk. Other risks with loan commitments. Credit risk, credit rating of the borrower may deteriorate over life of the commitment. Aggregate funding risk. During a credit crunch, bank may feel it difficult to meet all of the commitments. Banks may need to adjust their risk profile on the balance sheet in order to guard against future takedowns on loan commitments. Commercial LCs and SLCs. Particularly important for forging purchases if creditworthiness of the importer is unknown to seller or lower than the bank. Then gains available through using an LC. SLCs often used to insure risks that need not be trade related. Performance bond guarantees property and consulting. Insurers also prominent in selling FLCs. Foreign exchange rate quotes, price at which a currency can be exchanged for another. Direct quote, in the U.S. this means the price of foreign currency expressed in U.S. dollars. Example, U.S. dollars 0.8866 per Canadian dollar. Indirect quote, in the U.S. it means the price of the U.S. dollar in terms of the foreign currency. Example, 1.1279 per US dollar. Note that the term direct and indirect depend on where the quote is obtained. Direct quotes in Canada would be expressed in terms of $C per unit of foreign currency. FX risk exposure. FX may have positions in spot and forward markets. Could match foreign currency assets and liabilities to hedge FX risk. Must also hedge against emerging interest rate risk by matching duration. For example, financial holding companies have even greater ability to reduce their net exposure. Trends in FX. Value of foreign positions has increased. Volume of foreign currency trading has decreased. Causes. Corporate and investment banks merges increased trading efficiency through technological implementation. Introduction of the euro. Microeconomic factors, but average daily turnover has rebounded. Search for year. Trading activity. Basically, for trading activity, purchase and sale of currencies to complete international transactions, facultating positions and forging real and financial investments, accommodating hedging activities, spec- speculation, sustainable risk arises via open position. Profitability of FX trading. For large U.S. banks, trading income is a large and growing source of income. Valuation of European currencies are declining. Valuation in Asia and emerging markets currencies higher, but importance of these currencies remain relatively small. Risk arises from taking open positions in currencies. Foreign assets and liabilities. Mismatches between foreign assets and liability portfolios. Ability to raise funds from international diverse sources presents opportunities as well as risks. Return and risk of foreign investments. Returns are equivalent by spread between costs and revenues. Changes in FX rates. Changes in FX rates are not under the control of the FI, not unlike exposure to interest rate risk. Risk and hedging. Hedging can be constructed on balance sheet or off balance sheet. On balance sheet, hedge will also require duration matching to control exposure to foreign interest rate. Off balance sheet held using forward futures or options.